That building has no sign, no windows, nobody you can see, and it never once switches off. It draws more electricity than the whole town asleep beside it. Right now, hundreds more are going up across America, one after another, each in its own pool of light. 4 companies will spend $700 billion on them this year, 2% of the entire American economy. Proportionally, that beats the interstate highways and the moon landing combined. But here is the strange part. The companies investing the most are not the ones getting rich. So where does $700 billion actually end up? Before we start, subscribe. This channel follows the money, not the hype. Go back to 1849 and the California gold rush. Thousands arrived certain they would strike it rich, and almost every one of them went broke. But the people selling the shovels got paid every single day without ever finding an ounce of gold. The data center boom is that same trade at a scale that is hard to hold in your head. This time the shovels are chips, land, electricity and steel. Most coverage stops at the first one because it is the loudest. The other 3 are where the money quietly sits. Start with the obvious one anyway, because the numbers are genuinely absurd. In its most recent quarter, Nvidia reported $81.6 billion of revenue. That was one quarter, and it was up 85% from a year earlier. $75 billion of that came from data center products alone. Gross margins are running near 75%, which is extraordinary at that scale. For every dollar of product shipped, roughly 75 cents is gross profit. But there is one detail that tells you what this boom has become. Microsoft's chief executive said his company has AI chips it cannot plug in. They are sitting in inventory, still boxed, waiting. His explanation was blunt. The problem is not the supply of chips. The problem is that there are not enough warm shells to put them in. A warm shell is a finished building with power actually running to it. So the most valuable hardware ever manufactured is waiting on electricians. Everyone still frames this as a chip race, and it stopped being one. Chips can scale in months because the fabs are already built and running. Everything else in this chain takes years, and that is the whole story. Anything that takes years is a place where somebody holds enormous leverage. So let us go and find those people. A large campus needs land, and the average deal now runs around 200 acres. But raw acreage is not really what these companies are buying. The land has to be zoned for this use already. It also has to sit near transmission lines with real spare capacity. That combination has a name in the industry: powered land. And powered land now trades at 2 to 4 times ordinary industrial land. In Ashburn, Virginia, it has cleared $3.5 million an acre. In parts of Texas, land once worth $20,000 an acre now fetches far more. Some parcels along one highway corridor have sold above $350,000. One Virginia developer shows the whole trade in a single transaction. They assembled land at roughly $64,000 an acre. Then they got data center entitlements approved by the county. Then they sold the entitled site for about $600,000 an acre. That is close to 9 times their money in 18 months. They never poured a foundation or installed a single server. They changed a zoning designation and sold the paperwork. Meanwhile, the buildings themselves are spoken for before they exist. Vacancy in primary North American markets hit 1.4%. In Northern Virginia, it fell to 0.3%. Roughly 80% of space under construction is already leased. Those tenants move in years from now, and they have already signed. Land is only the second scarcest thing in this business. Here is the first, and it changes every other number. A single large campus can draw as much power as a small city. Unlike a city, it runs at full load all day, every day. American data centers were about 4% of peak summer demand last year. This year, that figure is around 5.3%. By 2030, Credible estimates run from 7 to 12% of all generation. But the number that actually explains the leverage is the queue. To connect anything large to the American grid, you get in line. Median time to commercial operation is now approaching 5 years. Projects that came online last year had waited over 7 on average. Roughly 3 of those years go to getting an interconnection agreement. The remaining 4 go to building and energizing the connection itself. The national backlog sits at something like 2,600 gigawatts. In Texas alone, the large load queue is 410 gigawatts. Data centers are 87% of that Texas queue. Around 80% of queued projects eventually withdraw entirely. That is why the deals look the way they do. In February, Google signed a 20-year agreement with AES in Texas. It signed another with Xcel, tied to 1,900 megawatts of new supply. There is one claim here that is worth being careful with. You have probably heard that data centers are why your power bill went up. The evidence is messier than that, and it cuts both ways. National retail prices really are up about 40% since 2020. But across all 50 states, there is no significant relationship. The number of data centers does not predict what residents pay. The effect is local rather than national, concentrated at specific grid nodes. Wholesale prices near the biggest clusters have risen as much as 267%, and it can cut the other way entirely. Regulators expect that Xcel deal to save other customers up to $1.5 billion. Your bill depends less on proximity than on what the regulator negotiated. Now, the least glamorous business in this chain, which is currently the best one. Building a data center now costs about $11.3 million per megawatt. In 2020, the same benchmark was $7.7 million. AI-specific facilities run $20 million per megawatt and climb from there. The most expensive part is not the computers and not the building. Electrical systems account for 40 to 45% of construction cost. Cooling accounts for another 15 to 20% on a standard build. For the liquid-cooled halls that new chips require, mechanical has climbed further. It has gone from 22% of facility cost to 33%. Which brings us to lead times, and they are remarkable. Substation transformers are quoted at 75 to 110 weeks. The largest generator step-up units run past 150 weeks. High-voltage circuit breakers sit at around 125 weeks. Switchgear has stretched beyond 60 weeks, up from 44 late last year. Industry reporting says switchgear is effectively sold out through 2028. And there is a choke point sitting behind all of those choke points. It is a material almost nobody outside the industry has heard of. Grain-oriented electrical steel is what transformer cores are made from. You cannot build a transformer without it, and substitutes do not exist. The United States has exactly one domestic producer of it. A multi-trillion-dollar technology boom is partly rate-limited by one steel mill. Now here is the part that changed everything in the last 12 months. The shovel sellers have started financing the miners. Cash from operations stopped covering this build-out somewhere in the last year. So the build-out moved onto debt, and mostly into places you cannot see. Private credit lending to AI infrastructure went from near zero to over $200 billion. Morgan Stanley expects another $800 billion of data center financing within 2 years. Total AI-related debt issuance is tracking toward roughly $570 billion this year. Much of it moves through bonds that are never registered with the SEC. They are sold privately to institutions, which means public disclosure is thin. Then look at the shapes these deals actually take. Meta's $27 billion Hyperion project is structured as a joint venture. An asset manager owns 80% of it, and Meta owns 20%. Part of the funding came from debt sold on to a bond investor. The effect is that most of that borrowing sits off Meta's balance sheet. In another deal, one company issued high-yield bonds to build a facility. A second company agreed to lease it for GPU clusters. Google then backstopped that second company's lease obligations. In exchange, Google received equity warrants in the company it was backstopping. Follow that circle carefully because it does not have a clean beginning. Nobody in the chain is purely the customer. Nobody in it is purely the lender either. So the clean version of the gold rush story no longer fully holds. Shovel sellers got paid regardless when they took cash and walked away. Increasingly, the shovel seller is holding paper on the mine itself. Bond investors have already started pushing back on this year's issuance. So who actually gets rich from data centers? It is not primarily the model companies, and that ledger is genuinely split. Anthropic reported its first operating profit this year. OpenAI is still losing more than $1 for every dollar of revenue. The reliable money is one layer down, and it always has been. It is the chipmaker and the developer who rezoned 400 acres. It is the utility, the steel mill, and the fund writing the loan. None of them need artificial intelligence to work out in the end. They get paid on the attempt rather than on the result. But the attempt is funded with borrowed money now. So the question has quietly changed shape. It is no longer only about who gets rich from all this. It is about who holds the paper if the tenant never arrives. What do you think happens to those buildings if the demand softens? Tell me in the comments and subscribe for the follow-up.